Hi, welcome back to Cheryl Trades Leaps. Most traders think volatility is the enemy. They fear red candles. They fear sudden drops. They fear market chaos. But professional traders see volatility very differently. Because volatility is not what destroys accounts. Oversized positions destroy accounts. And once you understand that difference, the entire market starts to look different. You stop seeing crashes as threats. You stop panicking during pullbacks. And instead of emotionally reacting to market chaos, you begin using volatility as a weapon. In this video, I want to show you why market volatility is actually one of the greatest advantages a disciplined trader can have, and how proper risk sizing transforms chaos into opportunity. Because the truth is, volatility is only dangerous when your position size is too large. Section 1. The Great Shakeout. Every major market cycle creates what I call the Great Shakeout. This is the phase where volatility suddenly expands, price swings become violent, and emotional traders begin making catastrophic decisions. We saw this repeatedly in recent years. One headline triggers panic. Another headline triggers euphoria. Stocks move 5%, 8%, even 10% in days. And during these periods, most retail traders do the exact same thing. They oversize positions. They chase momentum. They average down emotionally. And then volatility forces them out at the worst possible moment. But professional traders behave differently. They expect volatility. In fact, they prepare for it. Because volatility itself is not abnormal. Volatility is simply the market transferring money from emotional participants to disciplined participants. The problem is that most traders are carrying position sizes that are emotionally unbearable. And once a position becomes emotionally unbearable, logic disappears. Fear takes over. That's when traders panic sell, revenge trade, move, stops emotionally, or completely abandon their strategy. This is why I always say, if a normal market swing emotionally hurts you, your position size is too large. Not because you're weak, not because you lack intelligence, but because human psychology was never designed to handle excessive financial exposure. And this is exactly why position sizing is one of the greatest hidden edges in trading. Section 2. Why professionals think differently. Most retail traders think volatility means danger. Professionals often think volatility means opportunity. Why? Because volatility creates mispricing. When fear spikes, people stop acting rationally. They dump quality assets. They liquidate strong positions. They panic during temporary uncertainty. And this emotional behavior creates opportunity for disciplined traders with proper sizing. This is especially true in leaps trading. Because leaps traders are not trying to predict every short-term movement. They are trying to survive long enough for the larger trend to play out. That changes everything. When you understand this, you stop asking, how do I avoid volatility? And you start asking, how do I survive volatility long enough to benefit from it? That is a completely different mindset. Professionals know that volatility expands premiums, creates larger dislocations, and generates emotional overreactions. But none of those advantages matter if your position size forces you into emotional decisions. This is why the market rewards traders who remain calm while others become emotional. Section 3. The Volatility Coefficient. Now let's talk about one of the most important concepts in risk management, volatility-adjusted position sizing. Most traders use static sizing. They trade the same size during calm markets, during earnings, during CPI, during geopolitical panic, and during extreme market stress. That is incredibly dangerous, because volatility changes the risk profile of every position. The higher the volatility, the smaller your position size should become. This is how professionals maintain emotional stability. They do not try to eliminate volatility. They adjust exposure to volatility. Think about it this way. If a stock normally moves 2% per day and suddenly begins moving 8% per day, your position size should not remain the same, because your emotional exposure has increased dramatically. And this is where many traders fail. They size positions based on greed, not based on volatility. Professionals do the opposite. They reduce exposure when volatility expands. They increase exposure when conditions stabilize. This allows them to survive the noise without emotional liquidation. And survival is everything in trading, because compounding only works if you stay in the game. Section 4. The Dynamic Sizing Blueprint. Here's the mindset shift that changed everything for me. The goal is not maximizing profit per trade. The goal is maximizing long-term survivability. That means every position should be sized small enough that normal volatility does not emotionally destabilize you. For example, if a position dropping 10% causes panic, the position is too large. If earnings volatility keeps you awake at night, the position is too large. If you constantly stare at every candle, the position is too large. This is why professionals reduce size during earnings, high-gamma environments, major economic reports, and periods of expanding implied volatility. Because smaller size creates psychological freedom, and psychological freedom creates patience. This is also why I prefer scaling into leaps slowly instead of deploying everything at once. Because volatility often creates better entries later. And if you already used all your capital emotionally at the top, you lose the ability to take advantage of opportunity. This is where the concept of cash is a position becomes incredibly powerful. Cash is not weakness. Cash is optionality. Cash allows you to stay calm while others are forced into emotional decisions. And the trader with emotional stability often becomes the trader who survives long enough to compound wealth. Section 5. Using volatility as an advantage. Now here's where volatility becomes incredibly powerful. Once your sizing is correct, market fear starts working for you instead of against you. Why? Because emotional traders create price dislocations. They panic during temporary uncertainty. They dump positions emotionally. They create exaggerated moves. And disciplined traders can slowly accumulate quality positions during these periods. This is why some of the greatest long-term opportunities are born during moments of maximum fear. Not because professionals enjoy pain, but because they understand that volatility creates discounts. This is especially true with leaps, because long-duration options give time for the thesis to recover. But only if the trader survives emotionally long enough to hold them properly. That is the hidden secret. The edge is not prediction. The edge is emotional endurance. And emotional endurance comes from proper sizing. The market constantly transfers money from emotional participants to disciplined participants. Volatility simply accelerates that process. Section 6. The Mathematical Edge. Over a 12-month period, consistent risk sizing creates something extremely powerful, a smoother equity curve. Most traders underestimate how important this is, because massive drawdowns create psychological damage. A trader who loses 50% needs a 100% gain just to recover. But disciplined volatility-adjusted traders often avoid catastrophic losses entirely. Their gains may appear slower in the short term, but their consistency becomes explosive over time through compounding. This is one of the biggest differences between professional traders and emotional traders. Professionals focus on survival first, because survival creates compounding, and compounding creates wealth. That's why I believe volatility should not be feared. It should be respected. Because when position sizing is correct, volatility stops becoming a threat and starts becoming one of the greatest wealth-building opportunities in the entire market. So the next time the market becomes chaotic, the next time fear spikes, the next time volatility explodes, remember this: volatility does not destroy traders. Oversized positions destroy traders. The traders who survive long-term are usually not the smartest, not the fastest, and not the most aggressive. They are the traders who remain emotionally stable during chaos. Because in the end, the market rewards discipline far more than prediction. If you enjoyed this video, make sure to subscribe to the channel. And remember, cash is a position, patience is a strategy, and volatility can become your greatest advantage. Thank you for watching, and see you in the next video.